News Radio 700 WLW.
The Iranian situation, I say grinds on. It's only been, 4 days now?
Right. Seems like longer, but anytime these sort of global events happen, there's always some sort of reaction in the markets. Gas prices are up about 30, 40 cents from yesterday to today. I got it at $2.85 yesterday. It's $3.19 where I go. I just looked. The Dow is down 403. S&P down 65. Oil and gold are up. So, what does it all mean?
Let's talk to the guy we always go to in these situations. He's our financial strategist. He's a CPA money manager. He is our good friend, Bill Dendy. Bill, always our pleasure, buddy.
Hey, Rocky, Eddie, it's always good being with you guys. And it's kind of to be expected that we're going to have that knee-jerk reaction. We're going to have the movements because the market hates uncertainty. And when you start, when missiles start flying, uncertainty tends to move up. Yeah. But the market hasn't responded that poorly. I know 400 points sounds like a whole lot, but when we talk percentages, we see percentage moves all the time. That's less than 1% of a move. That's not the market behaves with a 10 to 20% drop. And that's kind of a good thing that they are concerned that we have this uncertainty, that certain companies that depend on oil, like the airlines and transport companies, they may not fare as well if they haven't hedged their bets on the price of oil, as the price of oil, as you mentioned, has gone up. So if you need a lot of that to do your outputs, that's going to hurt those types of companies. But overall, this response has not been crazy, except in the places you think it would be, which is when you have oil-producing countries having conflict in the region, you would expect the price of oil to move up. And it's been very clear that the U.S. is finally able to supply all the oil we need, but on a global basis, it creates that pressure.
So obviously, I mean, Bill, the strategy is don't start getting a trigger finger right with your stocks and all that sort of thing. Just kind of ride this out, and to your point, it's down, but it's not like catastrophically down. Like that could easily be expected as well.
That's correct, and things could change in a hurry. And the market was down worse yesterday. I think the first trading day reaction is, oh my gosh, take profits now, get someplace safe. And so we saw people, we saw bond interest rates actually went up because higher oil is kind of inflationary for the overall economy. And we saw gold go down, which is kind of surprising to some people because historically when we've had times of conflict, gold has been the safe haven, but it seems like the dollar has become the safe haven as people were looking for liquidity and flexibility in case things should not develop well. And thus far, the market's seeming to indicate that they're not worried that this is going to spiral out of control as to hurt our economy. That's not the case with other markets. Places that depend upon the oil from the Middle East for their major supply have been hit harder, and their prices may go up more dramatically. And so we're seeing this unlevel playing ground with the Asian markets and the U.S. markets just because of where we get our oil from and our being able to be self-reliant for our own production. This may also mean for a lot of people, it's a good time to reevaluate your market strategy. Things have been so good for so long that a lot of people have gotten a little complacent. We're like, yeah, the market's a place to make a lot of money. And we forget sometimes the risk that's inherent in the market and that the market does have these periods of contraction. And when the market contracts, it can contract hard, like in the year 2008 or the year 2000, where we had a 50% downdraw from the tops. 50% going away, that'll get your attention. 1 or 2%, not fun, but not a major drawdown. But if it made you uncomfortable to see the headlines and feel that concern, well, then maybe it is a good time to take profits and to reallocate assets into investments that don't move around as much. But as you say, for those who are comfortable with this and are long-term investors, This is just let it alone. If you're properly allocated, we're in for the long haul, and temporary strains, even if they last 6, 9 months, a year, that doesn't matter, provided the market is higher when we finally need to take the money out. And dips, gosh, for the young people, they see those as buying opportunities to be able to add more money in when things are less expensive than it was last month or last year. So it really is personal. It really is a good time to reassess where you are as an individual. And if you had that discomfort, it may be a time to look at those less volatile type of investments.
Bill, earlier you mentioned gold, but let me ask you actually specifically about silver, because I mean, go back to January of this year, and that thing silver was a rocket ship. I think $116 an ounce, something like that. And I think it was the announcement of the Treasury Secretary, something, that thing just cratered and went downhill big. And I know a lot of people that were invested in silver. How is that doing? Is that, now that it's down, is now the time to buy silver? What's your prospects on silver right now?
Well, it's interesting that silver has also had this over the last couple of days. We've had the dip. We're down to about $82 from 92 or so. So that percentage-wise, that's significant. But looking historically, silver has taken a big run up in just the past 2.5 years or so, having for a long time been around that $45 range, and then suddenly up to $82. So
wow.
For a lot of people, they've had some big gains on the short amount of time, and that's always a situation where, well, you got the fear of missing out, so you have others want to move in, but at the same time, you've got you got those who have profits over the past years who are saying, well, I've doubled my money, maybe this is a good time to exit. People don't know. If they knew for sure, they would be doing so well. There'd be no game to play in the market. There'd be
right.
that definite, boring, straight rates of return. People don't know. But today, we're off, 6% down to $82, and the volatility in silver is a lot of the attention that you get based on these news stories. So we can't advise on the short term on which way to go with that, other than to realize that there are risks in buying something near its all-time high. But if it's going to go to 200, it has to go through 80, 90, and 100 as well. So that's not an answer you're looking for, I know, but that is the best I can do, knowing that gold and silver both usually have been that safe haven. And over this time period, they actually pulled back a little bit after the news instead of moving up, as the dollar ended up being the safe haven that people went to. But again, it's only been about 48 hours of trading since the markets have been showing the results. Wow. And if this thing is more prolonged, or if more countries get involved, things could escalate further, and we could have more fallout in the S&P 500 and such.
Bill Dendy is our guest, our financial strategist. And Bill, I wanted to ask you about that. Considering the volatility of the situation, do you just, hold your cards close to your vest here and just kind of play a wait and see? Is there a play here involved that you might recommend? What are you saying?
There are a lot of people who are using this opportunity to transition their portfolio, to take advantage of some of the things that have dipped, in the hopes that this is a short-term skirmish, that it is resolved pretty quickly. The belief is that Trump does not really want to be in a prolonged war with Iran, but at the same time, the rhetoric is he's going to be there. Kind of like some of the rhetoric we've seen before in other areas where negotiation was involved. And so for a lot of traders, they're using the Trump rhetoric that is causing some knee-jerk reactions to be their buying opportunities to try to pick things up at a lower price, because they don't believe the rhetoric. They believe the long-term mission, and long-term mission is not to prolong or extend. Yet I don't know if people can really say they know for sure what's going on. I think that's the advantage that perhaps Trump wants to have in a negotiation is people don't really know what he's going to do, and so he wants to be perceived as that person that could do anything, so that people can't project. And because of that, I think that advising to trade on the opposite of what Trump says is just as bad as trading on exactly what Trump says. I think either way, you're setting yourself up to be disappointed. With that stated, take advantage if you are an investor that is growing a portfolio and you've got long term to go. The historical charts show that we are generally in an upward bias in the market, and pullbacks are just opportunities to get in at a lower price. Keep saving the same amount using your dollar cost averaging. For those who are closer to retirement or living off investments and are wanting to sell as they go forward, this may be a great opportunity to take some of the money off the table in the stock market while we're still near all-time highs and move into fixed income that is near its historic highs for the last 25 years, even though rates could continue to go up, given some flexibility within that laddered portfolio.
And Bill, I know you've been doing this for a while, and markets do react to things the president says and does. Compare that, though. Do the markets react more wildly to what Trump does compared to other presidents, or is it consistent?
What's different here is that Trump doesn't give a whole lot of pre-warning about what's going to happen. He doesn't seem to be concerned about jolting the markets. And when he jolts the markets, he seems to occasionally say, well, this will cause some short-term suffering, which was true when he talked about the tariffs, but it may have long-term results, and that we're going to do things across the board that he was really trying to bring people to a bargaining table, and those closest to him said it was a negotiation tactic. I think others were always more concerned about they wanted to broadcast or to foreshadow what they were going to do so as not to create uncertainty or a sense of imbalance. Even when they're negotiating against somebody, they seem to want to let them know what we were going to do next, so that everybody was playing with cards face up. And Trump tends to be the poker player that plays with his cards not shown and willing to call a bluff every so often or push all in to win an easy pot. And that is a bit different than what we've seen in the past. The Federal Reserve has traditionally been very careful to let us know that they are looking to perhaps raise rates and continue to raise rates for a period of time. Right. Or we're in a period of lowering rates as inflation seems to be under control. Not to have the surprise one way or the other unless there was a good reason behind it. It's a little different this time around. It does give better negotiation leverage, but it does create some concerns among those you're negotiating against and those who are on your side as well, not knowing exactly what's next. But that is something that Trump is doing differently than previous presidents.
All right. With that, Bill Dendy, we will let you go. People want to find out more about what it is you do. Where can they go?
That's alicorninvestmentmanagement.com. ALICORN. Alicorn is a unicorn with wings.
Bill, we appreciate it.
God bless you.